Hey, welcome to the live stream. Let's see what the market's doing today and see if there's any opportunities to get into some stocks. Let's evaluate stocks and look at their fundamentals. Sometimes stocks are popular, but I want to make sure they're valuable. If you look at the best companies on the stock market, the most valuable ones, they all produce high free cash flow. That's why I'm looking for high free cash flow.
Thanks for joining. We will get started in a few minutes.
All the best investors depended on free cash flow and evaluating a company's ability to generate free cash flow. A company is not the stock price, and the stock price is not the company. They're two different things. Two different things. The big cap stocks have taken the show, but are big cap stocks going to come back? Chinese stocks are exploding. The dragon has awakened in China. It could be the best trade we've seen in a while. AI hype is really interesting. AI is going to be interesting in the future, but is it really a business today? I'm going to pass on this stock. Just not enough discount, and I'm not really believing that they're going to grow as well as they should. Options can make your performance go a little higher every month and generate nice income. Listen to the great super investors. They are pretty generous with their knowledge and their wisdom. You just got to read their books and listen to their videos. Learn something new every month. In investing, you'll become a great investor. You'll build wealth. This is a buy stock. You're looking at a discounted stock, and it's unappreciated at this time. Don't forget about bonds. Bonds are a smooth, consistent way of earning a good return. And when stocks are really crashing, bonds stand up tall. Bonds stand up tall. You got to ring the cash register and take a gain. Defining when to sell a stock is a lot harder than determining when to buy a stock. And over time, you'll become a great investor and you will build great wealth.
Hey everyone, welcome. It's Thursday night. Man, it has been a real busy week with a lot of earnings going on. We've had some really interesting earnings, and we've had some big ones like Tesla. We had T-Mobile today. Intel just announced an hour or two ago. And we have more in store next week. This is kind of the warm-up week. And next week's going to be huge. We've got humongous earnings. Now, the market was in a mood to rally today. Russell was up 1.27. The NASDAQ was up 0.89. S&P was up nicely. So this market just continues to go higher. It's already expensive, but it doesn't care. It just keeps going higher. The encouraging thing is some stocks that were being left behind are catching up. And I'm going to point out a few and show you where there is some stocks that are going higher. And I think they have more left in the tank. They will be going higher. We will see how high they go by the end of the year. Paul, great to see you. Thanks for joining, sir. Hopefully you're having a terrific day. Your stocks went up a lot in value. You're feeling good about your portfolio. Thanks for joining. The S&P heat map, we had some stocks really moving today. Of course, NVIDIA went up Broadcom, AMD, Micron. We had the space that supports semiconductor. Lam Research announced they had good earnings, and that space is flourishing. Uber was flourishing. Palantir, much higher. Looks good. Nicely done, Palantir. Amazon's had a couple really good days this week. On Monday, it rallied. On Tuesday, it rallied. Took the day off yesterday. It's back, working for its investors. Tesla's was up. It was up for the day, even though last night, and I said it on the earnings watch party, it was down like 3.5%. And I wasn't convinced that it was going to stay down. This is Tesla. It's like quickly investors grow an appetite for Tesla, and it really showed up today. Aerospace and defense was green. Specialty industrial, GEV, that's power generator, went up. We had a move on oil prices, so it caused the energy space to catch a rally. It's 2 days in a row. We are having, I think the president put an embargo on the Russian oil. So if he puts that embargo and it takes that oil off the market, we're going to see higher oil prices, and that's going to help the energy companies. And those are the big ticket items on the heat map. It was a good day for the stock market. It is going higher. I wanted to take a peek at the biggest market cap companies and see how they're playing out this year. We are well into the 10th month of the year. So where are these stocks going to land for the year? NVIDIA is really, setting such a fine example for all the biggest market caps. It's up 35.65%. And Microsoft is at 23.5. Apple lagging the other big cap, stocks. Google Alphabet has really made up a lot of ground. I would say 5 months ago, Google was a little bit like Apple, just barely inking a positive return for 2025. But in quick time, it just shot up. Over the last 3 months, Google Alphabet has been the place to be. Amazon, I think, is the next stock to really take that momentum, kind of take the baton and really start moving up higher. It's had a couple good days this week. It has to continue to go higher. Amazon will announce next week. Alphabet will announce next week. Microsoft will announce next week. Apple will announce next week, and so will Meta. So there's going to be a lot of horsepower on display next week. It's going to be quite incredible. And I think I've got a Google comment here. Yeah, I think Google can go higher, especially if they're just Google, if they announce their sustainability of search, growing profits on search. If YouTube continues to grow its dominance on streaming, YouTube TV has been doing really well. Its Google Cloud business is doing great. That's going to be really interesting to hear how much more capital they're putting into the data center, because that'll affect semiconductor. So it'll be very interesting earnings. I think the day that three big companies announced, and let me take a look in a minute, but there's going to be one day where three of these giants will announce together. That's going to be a watch party. It's going to be like one of those concerts when you have three bands that are all great bands. You just get really, really high crowds, I hope. All right. So Meta is getting it done, 25% rate of return, but Meta's kind of had a couple months where it's not kept up with its peers, but it's still up 25%. So I'm not going to complain about it. I'm a Meta stockholder, so I'm good with that. Broadcom really doing well, 48.5. It is the best percentage gainer out of the top 10. Nicely done. TSM is right there at 47.2. The second best percentage appreciator. Nicely done. And Tesla went up today, and it's fallen behind, but it's in the green. So that's where that's at. So those are the biggest caps. Earnings. So earnings today in the morning, T-Mobile announced. I'll go over their announcement. I'll go over their valuation. Blackstone, go over Blackstone, Intel, Honeywell, Union Pacific. I'll also go over a couple of others like Ford, and I wanted to go over Deckers. And of course, I'll go over any stocks that you guys want to look at. If you're a member of my channel, if you're a paid member, you know the drill. You could put in a stock symbol. I'll take a look at it. We'll review it, analyze it, see what it's worth, see if it's potentially a good stock to consider. If it's a stock that maybe has a lot of problems and would probably be a stock I wouldn't consider, or if it's maybe a good watch stock. I already have one stock that was nominated, and it's a foreign stock, a German stock. So I'll show that to you in a little while. The symbol is VH2, and it's on the German stock exchange. So we'll get to that maybe after we look at some of these stocks that announced their earnings today. So this is today, and then tomorrow we're going to have more earnings. Biggest name being Procter & Gamble, the consumer staple company. Next week is when we start having some big hitters. On Tuesday, we have Visa, United Health, Novartis, HSBC, the Holdings, NextEra Energy, Bookings. So you have a pretty exciting Tuesday, but this is the day, Wednesday, where you have Microsoft, Google Alphabet, Meta. It's just collectively nearly more than $8 trillion of market cap. That is incredible. So we're looking at a really exciting day on Wednesday. I am for sure certain that I'm going to do some type of watch party. So look for the notice on that. On Thursday is also going to be a big day. We've got Apple, Amazon reporting together, Eli Lilly, which is a massive healthcare company, MasterCard, Merck. It just keeps coming. It's relentless. Then on Friday, these oil companies tend to announce together on Fridays. And this is the Friday they picked. They picked Halloween. So we'll see how they do on the 31st. They're catching a little bit of a tailwind with these higher oil prices here recently. We'll see what they announce. Exxon, Chevron, and others. AbbVie is also going to announce on Friday. So it's going to be a huge week next week. Let me get back to today. All right, so that's what's going on out there. Falls Grave, how are you, sir? Thanks for joining. Good to see you again. I've been seeing Falls Grave on my streams, which is great. Good to see you. All right, so let's get into some stocks. I kind of went over where the market's at. The market keeps rallying up. Longer term, like over the next 2 years, I expect the market's going to continue to go higher. You know, we could have some corrections along the way, but what leads me to believe that is the fact that we have lower interest rates pretty much coming. Lower interest rates make stocks more valuable. It really changes how we value stocks, and it makes them much more valuable. We'll revisit kind of like what we had going on in 2021, where we had stocks that really flew up. Now, hopefully it doesn't end like it ended in 2021, where 2022 was a pretty miserable year, but we'll see. We'll have to figure that out together. Looks like Carlos is out there. Good to see you, Carlos. Thanks for joining. All right, so let's get into some stocks, starting with Intel. Intel stock is going up in after hours, 7.26% after it announced earnings. And what did the market like? So this stock's been a little bit of a troubled company where it had some leadership that thought they could create a foundry and be in a really enviable position of being one of the few foundries in the world. And maybe the idea was good, but it wasn't executed well enough. And the short story is it just became kind of a dumpster fire. You see this graph, you're like, geez, 5 years, lose 29% over 5 years. That's miserable. More recently this year, it's really gotten a big lift, primarily with the government establishing a stake in Intel or supporting Intel. Then you have NVIDIA partnering with Intel. So some good things helped Intel. They really did need a catalyst and some assistance. But when you look at their fundamentals, it doesn't look good at all. You've got $181 billion market cap company. The forward PE is 164. They're not profitable this year. This is a well-established company. Why are they not profitable? We're having this monumental growth in technology, growth in the data center, and Intel is almost completely left out of that monumental expansion that we're seeing. They just bet on the wrong businesses going forward. Now, the numbers that I'm showing here are not going to include the most recent earnings. So I'll pop over their earnings report and show that year over year, they grew just by 3%. Again, these guys, they just haven't really put it together. If you look at like Broadcom, they're growing by leaps and bounds. NVIDIA is growing incredibly fast. These guys are not. And if you look at their data center business, it's actually contracting. So Intel is a little bit of a story where it got so bad that so long as these guys don't collapse and go out of business, the stock's probably going to rise. Plus the positive stories of the partnership with NVIDIA, the government's assistance of the company. Those are the things that are helping the stock. Because fundamentally, you're seeing a very broken business. You have year after year, sales declines. This is bad. This means that their semiconductors are not desirable enough. They're not being put into products often enough. And that means their competitors are being installed. In the data center, they're just not competitive. They didn't have the right semiconductors for what businesses want, what customers want. So when we look at their overall profitability, they are not profitable this year. They're actually losing money and burning a lot of cash for year after year, just burning cash and growing their debt. They used to be a mid 50% gross margin company. They have their own foundry. That's why their margins are not quite as good as NVIDIA. But now they're down to 33. Just not good. Your margins are really collapsed. Profitability's gone away. It's just, it's like, man, this is straight F's, failing. So those are the fundamentals that just look terrible for this business. Analysts, 23 of them are covering the stock. There's still some analysts saying, man, these guys are broken and they're worth $14 a share. The best case analyst is at 43. So the market's really taking the stock higher on the stories that have come out, but the fundamentals still look terrible. In fact, analysts are saying this stock is priced 30% too high. That's before the 7% rise. So the fundamentals better continue to follow the positive stories. They should begin to grow. They did grow in their earnings. They just announced they showed 3% growth. And they're celebrating that. All right, cool. We're not going to contract anymore. thank God. And they're going to begin to get profitable. That's good. But their PE will be high for a couple of years. I think they still have a lot to fix with Intel. I hope they fix it. They're a good company historically. That's really important. And we'll see how that plays out. I'm not in Intel. I think there's just too many problems. I don't want to just, follow this thing like a soap opera. I'd rather wait for it to get fixed or invest in a semiconductor company that is in better shape. So Intel is up nicely, and investors are happy with that. The stock did trade up 3% during normal trading hours, and in after hours, it's up more than 7%. Looks like Magical Self is in. How are you? You want to look at Arch Capital Group. I'll put that on the list. That's ACGL. You got it. Bear with me. I wanted to go over a string of stocks and then hit the request. All right. The next stock that I wanted to look at is Ford. Good old Ford Motor. And their stock is, going up 3.32% in after hours. It was down a little bit today. Year to date, the stock's up 24%. It pays a big dividend of 6%. And the 1 year up 11%, 5 year just up 50%. It really rallied. If you recall, when we had those supply chain shortages, these guys were able to charge a lot more per vehicle. So they were enjoying a brief period of time. But after that, it hasn't been all that great. This is an acceptable rate of return, but it's not, incredible. 3%, that's a pretty good evening. The market did like what they had to announce. In general, this is a slow grower. The car business is tough. It is a tough business to operate in. And these guys, this is their financials. This is from Ford. And in the third quarter, it grew their business from $46.2 billion up to $50.5 billion. That's a little over $4 billion of growth. So if I do some quick math on that, they grew by about 8%. In year to date, they really haven't grown that much. They've gone from over 9 months. If you compare the first 9 months of 2025 versus the first 9 months of 2024, they're going from 136.7 billion up to 141.3. That's not a lot of growth. That's not even 4 billion. So the growth really has been single digit and not overly impressive. So let's take a look at profitability, see if they're expanding profits. So the cost of sales is there. Okay, so the operating profit in the quarter was good. Year to date, not so good. So the quarter was a good one. That's probably why the stock's rising. The quarter did step up and show good numbers. Net income, 2.4 billion. That's a good quarter. So they put together a solid quarter, and Wall Street really likes what they're seeing. The car business is tough. This is a business that's been around more than 100 years. One of the original automotive giants, one of the historic companies in the U.S. economy, but they're only a $49 billion market cap company. They're not anywhere near like the most valuable, list of stocks. And, part of that is just, these are big businesses, $185 billion of revenue, but the profitability isn't very good. Gross margins, 7%. And other years maybe were better. Back in 21, 22, when they could charge more money for cars, there was a shortage of those cars. They were able to get a whopping 12% gross margin, which isn't very much. So it leaves very little left for the company, which is why these companies are not valuable and are maybe a good investment for somebody who wants that dividend. But overall, this is why these guys aren't one of the most valuable businesses on the market. It's just there's not a lot of profit left for investors. For me as an investor, I like to study the free cash flow and the profitability of a business and be realistic about what are the prospects for that business. Will they be able to really capture a lot of profit, capture a lot of free cash, and return it back to investors by buying back shares, providing dividends, or acquiring other businesses and increasing the enterprise value of a company? All those things are what I'm trying to measure. So when you see me evaluate and then value a company, I'm looking at a free cash flow forecast. I'm also looking at a forecast of profits and then doing a net present value calculation to get to what I think is a value for that stock. We'll do that a few times on this stream. But Ford's having a good night. Congratulations to the folks in Detroit. Analysts, 13 of them are covering Ford, and they think the stock's a little too expensive by 10%. Some analysts believe this stock's much too expensive. So we'll see how things play out. The forecast of revenue next year, they're not really going to grow. And then the year after that, very little growth. It's not going to be until 2028 that they have some measurable growth. And the whole EV business for these guys, I don't think it's been a big part of Ford. They've participated. They got an EV car, but I don't think it represents any substantial growth there. So that's where Ford is at. And the stock's moving higher in after hours. Blackstone. Blackstone announced before the market opened. And there is a particular trend, or I should say factor, that is going to hurt Blackstone and other private equity companies, which is declining interest rates. Blackstone would love to make deals with companies, provide some private equity for real estate projects and so forth, and provide that capital and be paid a high rate of return. But if you have low interest rates, it's going to put a ceiling on Blackstone of what they could charge, because you're going to have more competition driving down the interest rate that this private equity would be lent for. So although stocks would go up when you have lower interest rates, companies like Blackstone don't have as much revenue in the form of interest that they will earn on loans, short-term loans they're making, or maybe supporting an acquisition. Maybe they're funding some type of construction project where they don't get to make as much money because those rates are going to be lower. And I think that is what is weighing on Blackstone, is the whole expectation that maybe these guys aren't going to do as well over the next 2 to 3 years, because I think we are going to have lower interest rates over the next 2 to 3 years. So these guys sold off today after they announced their earnings this morning. Blackstone's not a stock I've ever owned. Over the 5-year, it's done really well. It should, because the market's done really well. So these guys were probably taking advantage of a market that was doing a lot of deals and so forth. The forecast for Blackstone, 16 analysts are covering the stock. They think the stock is discounted by 12%, and they expect that the firm is going to continue to grow. Top line growth. Profits are also going to grow. So Blackstone's, kind of being sold off in 2025, but I would keep an eye on them, and maybe this becomes a good investment, because their PE ratio is really going to drop from almost 30 down to 17 in 2028. So Blackstone. All right. So heading into T-Mobile. Before I do that, let me say hello to Peter. How you doing, Peter? You want to check out FDS? I'll take a look at that. I put it on the list. Bear with me. I've got a couple of stocks to go, and then we're going to get into the requests. So bear with me on that. So T-Mobile announced before the market opened and the stock sold off. The whole space sold off. And T-Mobile is the biggest market cap company within the telecom space. So they most definitely, if they have a bad day, the whole space is going to have a bad day. So AT&T and Verizon sold off. The market cap, $247 billion, revenue of $85 billion. Another reason why this might sell off as well is a day like today, it's risk on. Hey, investors were wanting to buy, stocks that are in the tech space, communication services, they're really expected to grow a lot. And telecom is treated like a safe industry, a safe haven for investors. It does well when investors want to take risk off, not put risk on. And today was a risk on day. So the whole space went down, partly because T-Mobile, their earnings were okay. They're growth companies, I'm going to show in a little bit, but their profits are really kind of not growing fast enough. So let's take a look. Market cap for T-Mobile, $247 billion, revenues of $85 billion, P/E ratio of 21. And they have a higher P/E ratio than Verizon or AT&T. These guys do have a higher growth rate, which is why they have a larger market cap. The dividend they pay, 1.6%. Analysts think that they are discounted by 19%. Year to date, these guys really haven't gotten it done. They're down 0.34%. The 1 year, haven't gotten it done. The 5 year, pretty respectable. 97% rate of return is good. And for a while, these guys were like the best run telecom, or at least the most highly appreciating telecom stock in the market. But now they haven't. They've kind of plateaued, and the market's not sure they want to be a T-Mobile investor. They are growing better than their peers in telecom. That looks good. But the expense of telecom just really weighs on the company. One thing that I was impressed with was the free cash flow looks terrific. It went up to $17.1 billion. That's really good. This company's really grown their cash flows. So they've gotten to a mature state. Now they're really cranking up the cash. Their gross margins are very good, better than their peers, better than Verizon and AT&T, and they are profitable. So it's looking pretty good. Verizon's looking pretty darn good. Looking at one thing you got to keep an eye on in telecom is they tend to carry a lot of debt, and that could be a burden. It could be risky. These guys carry $120 billion of debt. That's a lot of debt. When you go debt to EBITDA, just under 3. So they have an acceptable balance sheet, but I'm going to decrement that debt from their overall valuation. 21 analysts cover T-Mobile. They think it's discounted by 19%. The stock hasn't done anything for a year, so maybe the fundamentals have gotten better and the stock market hasn't increased their stock price. Maybe it's an opportunity. Let's keep looking. They're expected that they're going to keep growing. That looks good. This year they're growing by 10%. They're going to keep growing by 6.5%, 4.5%, and then another 4%. And their profits are going to keep expanding at a faster rate. So their PE ratio is going to come down. So that looks really good. Looking at a valuation for T-Mobile. I think the stock is discounted by 25%. The cash flows, I took the information they announced in their earnings. I created a cash forecast, discounted the future cash flows that I expect from the company to today's value using 8% discount rate. I get $464 billion. I'm going to take that $120 billion of debt away from that value and it settles down with an equity value of $347. 28% discount based on the value of cash flows. The value of profits provides a 16% discount. So this is a pretty good combination. This is a nice discount on a safe industry, safe stock industry. If we have a correction, you're going to see T-Mobile and Verizon and AT&T, their stocks rise because people will not disconnect their phones. It's a necessity these days. So you're just going to see that they have a very durable revenue, and they have a good T-Mobile, a very good cost structure. So these guys are looking good, looking really good. So T-Mobile would definitely be a watch stock for me, potentially a buy stock, just to have some safety stocks out there. Between T-Mobile, Verizon, I'll have to think about that, but both are watch stocks for me with a potential buy in the future. That is T-Mobile. All right, let me park the stocks that I wanted to look at for a minute. And we'll get into some of these stocks that are being requested. And we'll start with a stock out of Germany, ETR VH2. Now, this is a company I have no background with, so we're going to kind of learn this on the fly together. And I can't even pronounce the name, so I'll just let you read it. They provide various solutions for transformation and transportation of energy in Germany and Europe. The company operates through natural gas, electricity, clean hydrogen, adjacent opportunity segments. So they're taking natural gas, creating electricity. They're an engineering construction company within that space. So engineering construction is a space that seldom do you see an engineering construction company become really valuable. And it's because they don't have a sustainable revenue stream. They're going from project to project. So they always have to be earning the next project. And sometimes they have some drop-offs on their revenue streams. They're in the right space if they're dealing with electricity. Let's see where their revenues are at. The 1 year, this thing is just flying high, up 255%. 5 year, not so much. So they had kind of a sell-off for a long period of time, and then the market decided, no, this is really going to be a company for the times when we need all this power to be constructed. They wanted to go with it. When we look at the growth rate, this is why the stock's really moving, is they're really growing. 50.85%. That's growing really fast. Now, typical construction companies don't have a lot of profitability. Let's take a look. These guys have very adequate profitability. 50% is good. So they have a decent operating margin, okay profit margin, and free cash flow is pretty good. Free cash flow of 100 million. And is this in euros or is it in dollars? It's in euros. And euros are a little more valuable than a dollar, but they're pretty close. 16% more than a US dollar. So we'll think about that and add 16% to these values. So when we look at cash flows of 107, we're really saying cash flows of roughly 130 or so. Based on their industry, super high growth, I think this business would probably be worth $2.2 to $3 billion if they continue to grow nicely. Less debt. We'll take a look at their debt level. So 2 to 3 billion minus debt. When we look at their balance sheet, we'll take a look at their debt. Actually, I could see it here. And they don't have debt. Very good. So they're worth 2.2 to 3.2 billion. They're priced at 2 billion. So this might be an idea. Now for me, it's not a great idea because I stay away from construction companies just because they typically don't have sustainable revenues. It's not like they get to build a electricity generation plant and then collect revenues for the next 10 years. No, they build it once, they get paid once, and then they move on to the next project. So this one is an interesting project, but I would caution that, you got to make sure, how are these guys going to sustain their revenues? That's an important question. Let's take a look at their website and see if we can get a better understanding what they're doing. So they're doing engineering services, probably doing service contracts to keep operations running well. Yeah, they're doing these kinds of contracts or these projects. And it's really interesting what they do. It's not like, they're like, they're not like NVIDIA where they built this semiconductor that everybody wants and they get to sell it for years. These guys build the project, they're done, they get paid, and now they have to move on. So that's the piece that limits the overall long-term appreciation of engineering construction. It's not an industry that I really like to invest in, but I wanted to take a look at this stock for a member of the channel. And I would say, yeah, there's potentially a discount there, but it's outside my home country. There's just not enough there. It's not one of my favorite industries. In fact, I don't own any engineering and construction company. And I don't know that I want to own one, frankly. I'd rather own some other industries that have far more desirable aspects to them that can appreciate over time and grow my capital over time much better. So those are my comments on this company. All right, so let me catch up on a comment that I think I've seen come in. Let's see here. So Fallsgrave. So you want to look at the Granny Shots ETF. I do have some comments there. You may have caught it, but I do cover. This is Tom Lee's ETF, and it's kind of I'll kind of give you the background when we get into it. So Goldman's kind of a different animal. It will be affected by lower rates, but they are also probably going to benefit from more companies doing IPOs and doing public offerings. And then you're seeing some mergers, right? You've seen, I think, Warner Brothers Discovery is going to be acquired, and companies like Goldman are the ones that help with all that, and they charge a lot of fees. So they'll probably do well as you see IPOs, mergers, and that type of activity. And that will probably benefit them in a big way. So we'll see. All right, next stock up on the request, ACGL. ACGL, Arch Capital Group. What do these guys do? Arch Capital Group, together with its subsidiaries, provides insurance, reinsurance, mortgage insurance products in the US, Canada, Bermuda, United Kingdom, Europe, and Australia. Okay. So these guys are specialty insurance, reinsurance, mortgage insurance. Okay. So these guys are not like Progressive or Allstate. I think they're more institutional and they're more involved when people get a mortgage, and they're required to carry mortgage insurance. These guys come into the picture. So that's the industry they play in. Let's see what's been going on. Now, there is going to be more activity in refinancing and in mortgage loans because lower interest rates. These guys are not doing well year to date, and they're not catching a bid now that lower interest rates are expected. Yeah, the 1 year doesn't look good. They have a 5% dividend, 5.7% dividend. 5 years. So they did really well during these years. And for the last year and a half, they haven't done anything. So what was going on in these years here? We had inflation, we had increasing asset prices, the increased interest rates. It made life miserable for banks and insurance companies because they were insuring more expensive homes and cars. So for a period of time, they weren't making money. And these guys are flourishing during that time. But since then, not so much. So let's kind of revisit what they do, because that's really important, to get a handle on what's their business all about. And then kind of high level, see, is that going to be good or bad in the economy we expect in the next couple of years? So they're the insurance, and maybe since they're involved with so many property insurance policies, that is kind of a risky area, right? You have areas where you have wildfires, like in California, that could really hurt an insurance company. So insurance. So okay. So they're providing insurance to homes. Okay. So that's part of their business, insurance. And then what's reinsurance? I'm not sure what that term means. Okay. So I'm not very familiar with reinsurance. I'm not quite sure what it's used for. Is it for, it looks like they're insuring factory floors for potentially liability for fires and things like that. And then mortgage insurance. I am familiar with that. All right. So they're involved in the real estate market, right? Insuring homes and so forth. Now, the stock has been beaten up for the 1 year. And I don't know what's going to happen going forward. We have property values. They're keeping their values, like the price of homes is not going down. It's actually staying relatively high. So these insurance companies, should there be a fire or something that damage the home, they're going to be paying substantial amounts. So that's part of, I think, what is taken into account. Let's take a look at their revenue growth and so forth. These guys are going to announce their earnings on the 27th. So that's around the corner. That's going to be, I think, on Monday or Tuesday. These guys are growing quite well. The revenues are growing. Okay. So here's their premium business, okay? Making a little money on interest. And total of $19.1 billion in revenue in the trailing 12 months. Here are the benefits they're paying, well below their premiums that they're collecting. The underwriting, so that's what they're paying everybody who is writing the policies. They could be commissions to insurance brokers and so forth. It looks like I'm getting some help here. Thank you very much, sir. Magical Self. Reinsurance could mean to insure insurance companies. So an insurance company is going to Arch saying, hey, we would like to be insured by you in case something bad happens. You're going to also cover maybe a percentage of the loss or something. Okay. Makes sense. Okay. So back to these guys. I like the revenue growth. That looks really good. Earnings per share has dropped a little bit. Earnings per share has been contracting. So maybe that's what investors are kind of not liking, is their profits are coming down. Their free cash flows look really good. Very good. 6.1 billion. And they've grown it over time. That looks really good. And then the profit margin, 19.28%. Very good. These numbers look really, really good. So let's see if we've got, so they're going to have a little bit of debt, I would think, judging from like other insurance companies. So 2.7 billion in debt, 3.8 billion in cash. So a cash surplus looks good. Return on equity, good. And I want to see price to book 1.47. That is good. Like JP Morgan as an example is like 2.6. Some financial institutions, these guys are in the financials sector within the insurance industry. So I'm seeing a lot of value here. This is an interesting stock. I think it has a lot of value to it. I would just want to get my head around what's happened for the last year and a half. Why is the stock gone sideways after it increased so well? I have to understand this because this is really important, because what happened here that made the stock go up? Is it going to happen again? What happened here that's causing the stock to go down? And I would want to know that, because I think the fundamentals are going to show me that these guys are discounted substantially because they're doing more than $6 billion of cash flow. I could easily value these guys at 60 billion in market cap. I could value them as high as 90 billion. So the valuation's there, but I need to get my head around the business. So I think the fundamentals on ACGL show that it's a highly discounted stock that you need to understand what are the factors that are going to push the stock higher, and just understand them before you make a decision on a stock like this. The analysts, 13 of them cover it. They think it's discounted. The most bullish analyst is at 136. The most bearish analyst is believing that they're fairly priced. So there's not a lot of downside risk. Looks good. It's expected these guys are going to slow their growth. That's probably part of why the market's not buying them up, really fast, is they went from growing really fast to slamming on the brakes. There may have been an acquisition that created this type of growth, because they went from single digit growth, they grew really fast, and now they're back to single digit growth. So this single digit growth has to be explained. But if you catch this stock at the right time, you're probably going to make good money. You just have to do your homework, understand what the factors are going to be that move this. Try to study the charts. Like if you attend the morning stream, you you watch Daryl, look at his charts, you could see when one of these stocks begins to move higher. It's okay to be a little late on a rally, because I think this one can go up higher and really rally up 50%. And maybe you show up once it's already gone up 10%. Well, heck, a 40% appreciation over a 12-month period. I'll take that any day. I think this stock could do that, but it's going to require some homework. It's going to require watching this stock, then acting when an investor needs to act. So good one. Very good idea. And I hope you found my analysis interesting. I'm willing to watch that stock with you. If you want to keep bringing it up on the live streams, I'd really, and I forgot who asked about this one. I would ask you if you could try to figure out what has been the story or the trend that's kept the stock from going higher. Is it the expectation they're going to stop growing? So those are a couple of the important questions that I would ask. And if you can understand that, then maybe you've got something. With lower interest rates, insurance companies are going to do okay. They just won't be able to earn as much interest on the money and the premiums they get to hold, because they put it into T-bills and they earn interest on it. Well, they're not going to earn as much going forward because interest rates are going to be really low. So keep that in mind. So that is Arch Capital. Let's move over to FDS. Let me make sure I'm catching up on comments here. So what's my... So Big House, good to see you. So comments on Ethereum that coming out of Tom Lee. Sure. And you want to look at BMNR. BMNR. Opportunity for long term. Sure. Yeah, we can look at those. Okay. So let's go to FDS. FDS. FactSet Research Systems, together with its subs, operates as a financial digital platform and enterprise solutions provider for the investment community worldwide. The company provides workstations, portfolio analytics, enterprise data solutions, as well as managed services for supporting data, performance risk, and reporting workflows. Okay. They are financial data and stock exchanges within the financial space. So, okay, FactSet. I've seen these guys online, and they do provide a lot of data. These guys are most definitely interested in commodity data. Okay. All right. So they're selling analytics and data research, and businesses are buying it so they can trade whatever they're into, whether they're into commodities or other things that they're buying. Hedge funds are their customer. Okay. Wealth management firms. Data and platform providers. So if you see a website out there and they're providing really sophisticated data, they might be subscribing to FactSet and then repurposing that data and providing it to their customers. Okay. All right. So I understand what they do. They've really sold off. I think this most definitely is going to be an AI. AI is going to threaten these guys. I did something earlier today, which shows kind of like the power of AI. let me show that to you real quick. And I was interacting on Discord with fellow investors of this community, and the question came up. I invest in real estate. I've been investing in real estate and have done well with real estate. And the question was, hey, some people believe that you can have a very high rate of return with real estate. I'm like, yes, mainly because with real estate, you're leveraging a good part of the asset. So long as you have a real estate property that you can rent or lease, and it provides cash flows to pay for interest, to pay for its expenses, then you can really have a great rate of return, because your capital outlay at the beginning isn't very high, but you'll get full appreciation on the asset value. So I explained it to this person on Discord, and then I went to Gemini and I said, hey, Gemini, calculate the growth rate if I invested 70,000 and my equity has grown to 600,000. Gemini nailed it. It gave me the final answer, and it gave me the instructions on how to do it. It just nailed it. So back to our friends here at Fact Research. Well, Gemini, OpenAI, everybody else, they're going to be able to do a lot of stuff that these guys are doing. So the threat is real to these guys. In that example I just showed you, I could have done Google searches, created a quick spreadsheet, done my own kind of calculations, because that's how I had to get my undergraduate in accounting. And then I got an MBA. We were doing calculations left and right. We had to know the arithmetic. You can use computers all day long, but if you don't know the logic, you quite don't understand what you're looking at the end of the day. So these guys are going to be threatened by AI. And I think the threat is real. I know that some other types of stocks like Adobe, I don't think Adobe's being threatened really by AI. The market feels that way and is selling the stock off like crazy, but I think Adobe's going to be fine. I don't know that FactSet's going to be fine. I think FactSet is going to see a loss of customers and revenue because they're going to Gemini or ChatGPT or something like I just showed you the example that I did today. These guys, not a very good return over the last 5 years. Over the 1 year, terrible. This is where capital goes to die. And it's a small cap, 10.76 billion in market cap, revenue at 2.32. They are profitable. PE is reasonable. Dividend, analysts think it's discounted. So they could have. So they're grown by 5%. That's not high enough, and they're not a big business. Okay. So in order for them to prove that, hey, AI is not going to hurt us, they have to grow faster. That way they can get investors like me to believe, are you kidding me? These guys are growing in, faster and faster each year, and they're not going to be disrupted by AI. But at this point, you have to make AI a clear and present threat against this business. But let's carry on. This is single-digit growth, and they're small. Their profit is good, about 50% gross profit. Cash flow, good. They've grown it nicely too. Okay. They're nice, smooth growth of cash flow. Okay. Good profit, good free cash flow yield. These guys, they're worth 10 to 15 times free cash flow. So that would be 6 to 10 billion minus debt. And the reason I have a low valuation is, man, there's risk here. There is the threat of AI replacing these guys, like saying, hey, sorry, but what companies used to depend on you to get them, they could, boom, do it with OpenAI. They can do it with ChatGPT. They could do it with Gemini, and they can do it for a fraction of what you charge them. And they're really excited about using AI. They do have some debt, 1.56 billion. So this one here, I think, is priced too high given the risk. And let's do a quick valuation of this one, because this one here I think is a good one to do. So we looked at debt. They have a little bit of debt. Let's look at the forecast. And so I don't think their debt to EBITDA is going to be a problem. 1 billion wasn't that much. Yeah. Debt to EBITDA 1.6. So long as it's under 3, we're okay. So that looks okay. Forecast. We got 9 analysts covering this stock, and they think it's discounted. One analyst thinks, man, the market is missing out. This is a $500 stock. The most bearish analyst is like, this stock's fairly priced. But we've seen that big drop in the stock price while the market's been cranking up. So this is kind of a double, kind of like there's double the concern for me. It's like, why is this stock selling off while everything else is moving higher? And the markets these guys serve, like all these hedge funds and so forth, those guys are making money hand over fist right now. So why aren't they buying more of their product? They're going to be a slow grower. And that is concerning to me. They're small. They should be growing faster. They do have kind of a limited addressable market. It's not like they can sell their data services to everybody. No, they probably have certain pockets of the economy they can sell into. Hedge funds, oil companies, commodity-based companies that want to buy that data. So their addressable market is limited, and that's likely part of the reason why they're not growing really fast. Earnings per share is going to expand, but these numbers are not exciting. Okay, they're just okay. All right, so okay numbers. Let's do a valuation just to kind of work through the mechanics of this stock. I probably covered it, but when are they going to announce earnings? September 18th. So they announced them September 18th. So they're going to announce again mid-December. If I went 3 months past September, we'd be at December 18th. Okay, so let's take a look at FDS. Let me open up the valuation model. And these guys I could probably compare. Who would they be a good compare? So SPG, I think, is SP Global. Oh, I didn't keep it. Okay. I don't have a company like them. So I'm going to end up going with I'll just pop them in here. Okay, so what we're going to do is we're going to forecast the free cash flows for FDS. We're also going to forecast their profitability and see what a fair price is. And as we work through the numbers, right, we looked at this business. We started to form, and I should say I started to form some opinions and expectations and kind of guessing at some trends that I'm seeing out there. Biggest one being, hey, AI could disrupt these guys. I could see data companies being in big trouble if they used to charge for something that now gets provided for free. I'll give you a quick example. Roughly 20 years ago, there's a company by the name of TMUS, and TMUS is in France. And they owned a company by the name of Magellan. And 20 years ago, you would buy a navigation device, and you'd suction cup it to your windshield, and it would give you turn-by-turn navigation. It was brilliant. You could buy a device for $300. The best device you could buy for $1,000. And it would give you turn-by-turn navigation. Really cool. Well, when iPhones came out and Samsung smartphones came out and Google Maps was free, that business got destroyed. It was like, okay, no need for a hardware device company that sells navigation devices to exist anymore. And they were pretty much like completely disrupted. That's what could happen to data companies if you now have AI that comes into the picture and says, hey, stuff you used to pay for, you can get for free. That's going to be hard on the company that used to charge for that data. So that is reality in today's world, where we have a fully connected planet. We have companies like OpenAI just showing that they could provide more and more information. Gemini right there with them, showing you, like my use of it today. And I'm using it every day, by the way. I'm using Gemini, and it's become pretty darn useful. Now I'm going to put a discount rate of 9. A really good company, I'd put 7.5, because I am concerned. I think these guys need to prove to me that they are a grower, not a company that's just sitting there waiting to be disrupted. So let's start with their cash flows. I do like how they were growing their cash flows, and they're at $617 million. They're growing those cash flows by 5%. That's the growth rate on their revenue. So here's your cash flow going out. Then long-term growth at 4%. Okay. So we've got cash on the balance sheet was $355 million. And then they had some debt. Shares outstanding, 37 million shares. So they're being discounted by 4% if I measure the cash flows. Now, again, I think they're being threatened by AI. If I were to go to, they have some debt, so the best I could do is like 8% in a perfect world. You would get a modest discount of 25%. But in the case of these guys, I'm looking at the situation. That's why it's really important to make these qualitative decisions about a company. We're looking at FactSet. Where do they operate? What's their business? They're in the data business, right? Well, AI is going to serve up data better than we've ever had it. And how is that going to affect these guys? You're seeing so many industries get disrupted right before our eyes, right? Like media, just getting destroyed by streaming, especially YouTube. It's just going to happen. Technology evolves, like the classic compare is back when 150 years ago, when everybody rode horses and buggies, there was a lot of saddle makers. If you wanted to ride a horse, you needed a saddle. So when the cars came out, well, there were a lot of unemployed saddle makers. So they had to retrain themselves and maybe go make seats for automobiles, but they were disrupted because a new technology came into the picture. That's what I'm seeing in AI as it relates to FactSet. So, all right. So earnings per share. Let's take a look at that number. How are their profits going to be? And the profits are going to be good in 2026. They're going to be 1784. So these guys are slow grow. Best I can do is 12. It's an industry where I'm like, I'm not quite sure what's going to happen to them. So I'm not going to pay IPE. Their growth of that profitability isn't expected to be all that high. So this business is just not something I'd want to enter the picture in. I think the market's right on this stock that, hey, there are some factors that are weighing on the stock, like they're concerned. And the company, they're trying their best, but the growth rate when they're a small business, just to be single digit, like 5%, that just doesn't instill confidence in me as an investor. And that is just part of the concern is you're not growing that fast. AI could take away a quarter of your business, half of your business, a good part of your business, and that would really be detrimental to you for sure. So that is FDS, full evaluation, and I hope you found it interesting. Good one. I hadn't seen this. So I'd seen this company online because I think I've probably got there through a couple searches. So I'm familiar with the brand, but the market's right on this one. Going back to what the market's been doing with this stock, sometimes the market's right. Sometimes the market's like, you know what? These guys aren't going to do all that great going forward. And it prices the stock appropriately. All right. FDS in the books. That was Peter, man. Peter, you come up with some really interesting stocks, sir. Peter is a young investor, if you don't mind me saying, and he tends to bring stocks to live streams and investor calls that I've never heard of. So I commend you for that. It's like, holy smokes, never heard of that one. All right, let's talk about granny shots. If you can put your ego aside playing basketball, you could take a granny shot for the team. This is the Granny Shots portfolio. Tom Lee is the man behind the portfolio. And what he does, it's going to be described here. The FundStrat Granny Shots US Large Cap ETF is an exchange traded fund that mostly invests in large cap equity. The fund is an actively managed ETF that invests in 20 to 50 US large cap securities across 5 to 10 themes determined to likely impact the economy and stock market. And when you go to their website, you'll see if they provide a link to their website. They don't. So we could easily get to it. The themes that they're believing in you find the portfolio itself. All right. So the themes, where do they have the themes? I researched this. I put Tom in my top like famous investors rankings, and here they are. So the themes, so seasonality, PMI recovery, energy, cybersecurity, okay, millennials, global labor suppliers, easing financial conditions. No, I agree with this one. Like, easing financial conditions. And then what they do is they pick companies that are going to benefit from this situation. And looks like anything with a black box would give you like SPGI. I think that's Stanley & Poor's Global. And we reviewed that stock yesterday. It doesn't look all that great, by the way. So this guy's, they're kind of taking like a big picture model or establish the big themes and then select some stocks that are going to be benefiting from it. And his performance has been good. It hasn't been number one, but it's been good. It's a little behind, but I think he was ranking like 5th, 6th, 7th on the rankings. The best guys are like David Tepper is number one, and other guys are way ahead of Tom Lee, or at least this particular fund. And in the first quarter, this fund was doing miserably, by the way. So they got it all wrong first quarter. They corrected it second quarter. And I think they put their performance out here. Let's see here. Actually, we'll see it on stock analysis. So year to date. So you see that in Q2, when you had this big recovery, they were cranking. Now they're up 27%, which is very good. But David Tepper's up at like 38% last time I looked. My portfolio is up 33%. And I don't have to pay this guy expense ratio. I think he charges 1.25, 2% of your money. So this isn't 27, it's 27 minus the management fee. And if he has a bad year, it's 7.75%. So it's not that bad. So it's 27 minus 0.75. So that's been pretty decent. The holdings that he has right now, it'll be interesting to check out. Tesla, interesting. Well, if Tesla does well, these guys are going to do well. And they really spread their risk across so many stocks, 41 of them, where my portfolio, I have some big bets. I have like about 12% in Meta, 10% in Google Alphabet, 9% in Robinhood, Uber's like 7-8%. So I'm not like dividing by 40 and getting all these small positions. Lam Research is doing really well. AMD is doing great. Caterpillar, I don't know. Google Alphabet's doing great. Hood is doing great. Palo Alto is doing well. I don't know. Doing great. Doing okay. Doing great. And these guys really move in and out of these positions, by the way. If you look at, and I could just open up his portfolio based on, opened up the wrong one. This is a little dated, but you could see like in the first quarter, he had a lot of red. And then the second quarter, a lot of green. And I got to do the third quarter for him, and we'll see where he lands. But that's pretty, I'm just tracking his granny shots portfolio. But he does change his portfolio around. Like what we just looked at, Robinhood was number one in the second quarter, but now I think it was Tesla. Oracle's still there. So he really changes things around. So it's a pretty good fund. I mean, he's been doing well this year, but I don't think the fund's been around for a long time. Let's look at the history. Yeah, it's only been around for a year. And I like Tom Lee, but he's a perma bull. He's like, I've never heard him say, I think the market's going to go down for these reasons. It's always like, it's going to go up. It could have gone up like 15% in a month. And he's like, yeah, it's going to continue to go up. It could have gone down like the big drop here. He was like, yeah, it's going to go up. Boom. But he always says that. If you study him a couple of years ago, he was saying the same thing. Even in 2022, when everything was dropping, oh yeah, it's going to go up. And it kept dropping for like 6 to 12 months. So I like him a lot. I think he says a lot of intelligent things. And I could always learn from any good investor that's talking, because I may not copy certain things, but I may understand their perspective and be able to establish a little better understanding of what's happening, or maybe get an idea or two. And I certainly get ideas from Tom Lee. I appreciate listening to him talk. I just kind of ignore some of his constant optimism on how stocks are going to go way much higher. So that's granny shots. Now, there was a question on, so what he's trying to do with, what Tom Lee's trying to do with Ether, right? And I'll kind of talk about it without any visuals. So Ethereum is a cryptocurrency coin. It's a layer 2 network, and it came in after Bitcoin. Bitcoin is a store of value. It's not necessarily used where businesses are building new businesses on Bitcoin. But I'll give you an example. Kalshi, I believe, and its competitor are built on Ethereum. It's what they've built on top of, which is what we're going to start seeing is these new businesses are going to build on the blockchain. They're going to build on these new technologies that are more efficient. That's great. How's that going to affect Ethereum? I owned Ethereum coins from 2018 to 2024, 7 years. And the rate of appreciation on Ethereum was not as good as Bitcoin. So I kept my Bitcoin, I sold my Ethereum coins. What you're able to do with Ethereum, and I heard a really nice description of it, which was you have to stake your Ethereum. And staking is like you're lending out your Ethereum coins, putting them into the network so they provide liquidity. And you're, in essence, given like a dividend or a return for you putting your coins out there. If you're going to hold them, what's the difference, right? You just put them out there and it provides liquidity. But the staking returns that are being provided is basically minting new Ethereum coins to pay for the staking. So if you don't stake, your coins are actually losing value. You're losing value because everybody else is staking. There's more coins being minted, so all investors are being liquidated. But if you're earning a staking credit, you're keeping up with what would be the rate of liquidation in the whole network. I believe that FundStrat is trying to manufacture some value there, and I'm not convinced that there's going to be value to be manufactured. I think it's going to be a modest return, but I don't know how it's going to be a big idea. I don't. I think the big idea would probably be better at some point. I wouldn't mind investing in Kalshi, and its competitors, because I think prediction markets have a future. They're certainly getting a lot of excitement. So we'll see what happens. So that's my comment on what they're doing with Ethereum. And I've only studied that a little bit, but I do know enough where I'm not really interested in it because I'm like, I'm invested in Bitcoin. I'd rather keep investing in Bitcoin. What other things within crypto am I interested in? I am interested in companies that are building businesses on crypto that are real businesses. I am interested in that. So we'll see what comes up. All right, let's keep rocking here. Big House wants to look at BMNR. And then Carlos, you want to look at VEEV? That's a systems company, if I recall. Put that on the list. You want to look at Root? Yeah, I sold my Root, and I did a full video on insurance. I encourage you to watch it, and I'll comment on it when I get to Root. So BMNR. All right, you guys are going crypto tonight. Bitmine. So Bitmine Immersion Technologies operates as a blockchain technology company primarily in the US. The company engages in hosting third-party equipment used in the mining of digital asset coins and tokens, primarily Bitcoin, as well as self-mining for its own account. So they are... So these guys are a data center company. Why are they put into financials, capital markets? Let's take a look at their website to confirm I'm understanding them correctly. So establishing the world's premier Ethereum treasury. So these guys are kind of doing what Tom Lee is trying to do, but these guys are probably more informed about it, by the way. Tom Lee's a finance guy who sees Ethereum, in my opinion, who sees Ethereum as an opportunity. These guys are probably founded by crypto people. These guys live, breathe crypto 24/7. High level opinion on my part. So So these guys, so he created Bitmine, or he's a chairman of it? So how are they going to make money? So they're going to have a treasury of Ethereum. You can stake it. Got it. I just don't know how they're going to make money. Got it. He's the chairman. Because staking, like when I was staking my Ethereum coins, I think I was earning like 4%. And it's like, yippee. In crypto, I really like the return I got on Bitcoin. Bought coins starting in 2017. The coins were selling for like $1,500. They went up to 15,000, and I thought, wow, man, they're getting expensive. Now they're 100 and however much thousand. But they were really risky back in 2018, right? Ethereum never went anywhere. It was just kind of like there. And I was like, it's kind of like unpredictable and it hasn't kept up with Bitcoin. So I just really focused on Bitcoin. So this isn't kind of like the business that I'm excited about, because these guys are finance people that want to hold a bunch of Ethereum. They want to earn a little bit of staking. And Tom Lee and his firm, they want to sponge money off this fund or this company, right? There's no innovation here that I'm seeing. It's one thing for like, so these guys, I believe, are built on Ethereum. Let me confirm that. Polymarket is built on Ethereum, according to my son. So Polymarket's built on Ethereum, and that's the competitor to Kalshi. And Polymarket's big. I'm excited about these businesses. These guys are creating value. They're creating a market that's disrupting the gambling websites, and it's creating a really cool experience, right? If you go to Kalshi or Polymarket, you could, like, tonight is a football game. And you can bet on the game tonight. I forgot who was going to play. I think the Chargers are playing, the Vikings. So you can bet on one team or the other, and kickoff is in like 25 minutes. And this is cool. But more importantly, you can look at other more obscure events that are going to happen. To me, this is value, right? They're creating a new category. They're bringing in new participants into a market. This is all value. This is what I'm excited about. I am not excited about, a group of investors coming in and saying, hey, everybody's crazy about crypto because, Bitcoin's been going up so much that, it's caught everybody's attention. So let's create a fund, and then we're going to charge people or a company. They're going to be excited about it. I don't think it's going to end up being much. It's up a lot from it IPO'd recently, so we'll see where it lands. Yeah. So not something I'm interested in. Yeah. I'm not the world's expert on crypto, by the way, but I did invest in it starting in 2017, 2018. So I'm not going to say wise enough to invest in it, but I was willing to kind of go out on a limb, start buying it. And I thought, oh no, look at this crash. Oh, so it kind of scared me a bit, going, okay, well, there's a couple $1,000 down the drain. And then from there, it's like, nope. I should have bet big. I should have put 100,000 on it. Then I'd be like, yeah, cool. I got millions. Instead, I put logical amounts, got my crypto part of my portfolio up to like $250,000 in value. And then I sold my Ethereum. I did sell some Bitcoin, bring it down because I wanted to bring my risk down. And I needed to do that. So I did benefit from crypto. I wasn't on the sidelines on that one. All right. So that was Bitmine. Thanks for asking. I don't think I added much value there, guys, but I did give you kind of if anything, you get to know me a little bit better, that I am invested in Bitcoin, but that's about it. I'm excited about next generation businesses. That does really excite me. All right. Okay. So next stock we can go into is Veeva Systems. So what do these guys do? Veeva Systems provides cloud-based software for the life sciences industry in North America, Europe, Asia Pacific, Middle East. Okay. So I like what they're doing, but the healthcare industry's just been getting hammered. Like Merck stock's way down. So they're servicing an industry that's, at least from a stock perspective, has not done really well. Now, the current administration is pulling back a lot of funding for healthcare. That may affect them. Some of these companies, I know United Therapeutics, I'm an investor. So these guys are selling into that space. Okay. So they manage the clinical, maybe the clinical trials process, regulatory, quality, commercialization, the medical relationships. So you get some experts in the field to maybe be a part of the development of a drug and maybe be part of a board that is overseeing the development of a treatment, that kind of thing. Okay. So I get what they're doing. Let's see what they're doing from, just look at the fundamentals and see if they're growing. Year to date, they're doing great from a stock appreciation perspective. 5-year, not so great. They really sold off here. But they've been having a very good year. 47.78 billion, revenues of 3 billion, excuse me. So you're paying about 16 to 18 times sales, which is a little expensive. We'll see how they're growing. P ratio is 60, moving to 36. So the growth is okay. It's not exciting, right? 15% is okay because they're a small business. They're not that big. They are accelerating to some extent. They're accelerating their growth a little bit. They're good and profitable. They're still small, but they have 75% gross margins, very good cash flow that's been growing at a very good rate. These guys are worth, I would say about $39 billion minus debt. Just looking at their free cash flow number. And they have very good metrics. Okay. They have good net profit, very good cash flow generation. Just that top line growth is not superb, right? 15% for a small business. That's not like super exciting. Let's see how much debt they have. I imagine they'll probably have no debt. Yeah, close to no debt. They actually have a surplus of $6.32 billion. So my valuation goes up to $45 billion, and they're being priced at $47 billion. So they're fairly priced. I think the opportunity on this stock has been captured by investors who acted a year ago, and now this stock is close to fairly priced. The way that this stock can continue to work is if they accelerate their revenue growth. And it looks like it's going to be in the teens for a while. And I think that's going to sustain the stock, right? It's going to get into the mid-20s PE. I don't think there's enough there for me to be excited. This one here, if we knew it was going to grow better a year ago, that was a time to buy into it, of course. And you have some dissension among the analysts. They think it's fairly priced. I think it's fairly priced. And you have some analysts that are like, this is priced too high. Some are saying priced too low, but on average, it's priced right. So not a lot of meat left on this bone. I think it's been taken by investors who acted previously. It looks like they probably had a very good earnings here. And congratulations to anybody that owns them. These guys here, when you compare them to like Adobe's growing 11%, and they're huge compared to these guys. And Adobe's not getting any love. CRM, Salesforce, they're growing at a decent rate. They're massive. They're not getting much love. So we'll see when those start getting some love. My money is going to go into CRM, Salesforce, and Adobe, and some other software stocks. So thanks for asking about Veeva Systems, Carlos. So you wanted to talk about Root. So let's talk about Root. So Root is an insurance company. What I really like about them is they have like a new way of selling insurance. And I think the advantage they could have is in the insurance business, you just sit through tonight's football game. You're going to be, provided no less than commercials from at least 4 insurance companies: Allstate, Progressive, Geico, USAA with Gronk, and then there's Peyton Manning does a nationwide. So they have to spend so much money to get customers or steal customers from other insurance companies, where Root is kind of doing it differently. They're taking the digital route, and I think they do that far better. So their new customer acquisition model is far better. But some metrics exist with the business that don't look good. Let me show you the metrics. So I did some research on insurance. I like to do that for industries. And what's good about doing that is you could then compare businesses in the same industry. In this case here, insurance, right? Here I've got 7 companies: Allstate. I think this one's Palomar. This is, forgot their name. And this one's Old Republic, Progressive, Chubb, and Root. So Root, if they got a red number, that's bad. So P ratio, the worst one in the pack. Combined ratio. Combined ratio is 100% means that your expenses are exactly the level of your policies. That's not good. You're not making any money. You want to be here. Palomar has a combined ratio, an expense ratio of 79. So they get $100 of policies. They only have to pay out $79. They keep $21 in profit. And the second worst is Root. Well, that's not good. The price to book, Root's the most expensive. So I owned passive tense Root up until I did this report, and then I sold it on Monday. I'm like, I got to get out of this stock. There's too much risk. I own Allstate. It has some good rankings on PE. The combined ratio is better. Return on equity is good. Price to book is decent. So this one's pretty good, lower risk. And then there's some other options up here. Now, if Root gets a little better, their PE goes down. It becomes more comparable to its peers. If they can improve their combined ratio, get it to 90, maybe get it into the 80s, that'd be superb. And if they get their price to book far better than that, now we're talking. So that's some of my research I did on them. The 1 year this thing really shot up, and it's really come down. So I kind of got out of harm's way, so to speak. I'll just let this thing settle down. I'll wait for their metrics to get better, and then I'll jump into it because this thing is discounted based on the super high growth rate. I mean, we were looking at a stock with Veeva that was growing 15%, right? These guys, now that's what we're talking about, 59.76. That's the kind of growth that we want to see. And that's really exciting. But right now, they got to get their metrics a little stronger. And then I'll be really excited. If they can keep growing at these rates, you better believe I'm going to be watching this stock. I'm going to be buying it in the future. But for now, I'm just going to stay on the sidelines. I'm going to let it get a little stronger, a little older, and invest at the right time. So that's my story on Root. And I covered Root in that video. Covered Root in the stream yesterday as well. Glad to cover it as many times because, you know, I like sharing my research and sharing it with you guys. All right. Benton, how are you, sir? Have I evaluated? So looks like we're going to look at AMBA. I don't think I've evaluated this one. So let's take a look. I'm going to keep that one around. I may want to talk about that later. AMBA. Ambarella. So these guys, good things are happening, although there's pretty extreme volatility, but everybody was selling off here. So it can't hold that against them. The 5-year, wow. That's pretty scary looking. All right. Year to date, 14. Ambarella develops semiconductor solutions that enable artificial intelligence processing, advanced image signal processing, and high definition ultra HD compression. Okay. So these guys are, our solutions make cameras smarter by extracting valuable data from high resolution video streams. Okay. Let's explore their technologies. Onboard intelligence for low power, high resolution cameras. Automotive, security, consumer, Internet of Things. Okay. All right. So I like that they're going into this industry. Now, I'm sorry, that they're advancing this technology. Just the industries they're in are not the greatest, right? Automotive is not awesome, although this could really be used. Security, definitely, or maybe I should disqualify my opinion there. I don't know too much about security. Automotive tends to be kind of a undesirable industry to me. I know that we all like our cars, but there's not a lot of money to be made there. And the unit sales are kind of flat year over year. So, and then the consumer, I imagine consumer products, and then industrial robotics. Okay. Got it. Let's see if these guys are growing. So 3.56 billion in market cap. So this is a small cap with 348 million in revenue. Forward P is 200. Strong buy, discounted by 12%. Growth looks really interesting. 57% growth in quarterly. The last quarter they closed July 31st. They grew by 50%. That looks terrific. It's a good growth. And they're already free cash flowing. Very good. Gross margins, 60%. They're not making any money yet. Okay. So to get to their market cap, I'd have to go 100 times cash flow. And I'm not ready to do that. Maybe I'd go 30, but not 100. Make sure they don't have any debt. Nope. They got 3 million of debt, 261 million of cash. Let's look at their forecast. Got 9 analysts covering them. And oh no, they're going to stop growing. That's not good. That takes away a lot of the excitement. So these guys are really priced expensively, 100 times revenue. But revenue could change quickly. But their revenue is going to slow down. Well, that's not good. That would be a big showstopper for me. Is revenue isn't going to grow. I wouldn't see a reason to own this stock. And I think the big drops in the stock price have been the concerns that, hey, if you're not going to grow, there's no excitement. That means the market isn't excited about the product itself. And this one here is an interesting stock, but it's just priced too high, too much risk. If they had some numbers here that were just constant growth, like, hey, they're going to keep growing into the future at high rates. They weren't going to have a let up year here that's going to start February 1 of 2026, and they're going to have a slow year. That concerns me. And 17 analysts are weighing in on that. So, yeah, it wouldn't be the right stock for me. So that is Ambarella. Thanks for asking about that. Interesting company. All right, guys. So we are cranking along here. We're at the 2-hour mark. I am trying to put on the football game. That way I can stay informed on the National Football League. All right, I'll let that kind of do its thing. We went over Veeva. Veeva. We went over Root. We handled Ambarella, which was interesting. And, you know, as we look at Ambarella, more and more companies are going to come out of the woodwork. They're going to use AI as kind of a jumping off point. New products, new solutions. It's going to be an interesting 5 to 10 years. And there's probably going to be some companies that are going to be incredibly awesome and incredibly valuable and make us a lot of money. But we got to really treat the real companies with real exciting products with real growth, really jump all over those, invest in them, and, you know, clear away kind of some of the clutter, which will be a lot of companies are just saying, hey, we're an AI company because we want a high valuation, but they really don't have an awesome product. The financial statements tell us real life, you know, what the end market is doing with the stock, or doing with the product. If the end market is buying it up and you're seeing high growth over and over and over again, that's evidence that their product is good. And if we really understand the big picture, the qualitative aspects of a business, you know, we're better off for it. Okay. So, all right. So there's a couple of stocks that announced that I have prepared, and I wanted to take a look at, if you guys don't mind. Of course, if you guys want me to look at other stocks, you're a member, pop it in the chat. You're not a member, no big deal. $5 super chat, and we will take a look at your stock. And I don't think I missed anybody, but in case I did, I apologize in advance. I don't mean to miss any comments. It's just I'm a one-person operation. Sometimes I miss a comment. So I'll double check here to make sure I'm not missing any comments. No, I think I'm good. So think I'm good. All right. So we're going to take a look at so Honeywell was up 6.8% after announcing earnings. Honeywell is an industrial stock. They're not doing that great this year. For the 1 year, it's not good. The 5 year, not good. But something happened today that created investor excitement. So let's take a closer look. So Honeywell engages in the aerospace technologies, industrial automation, building automation, energy, and sustainable solutions business. Yep. Yeah, these guys do a lot of products. You see them in industrial applications, aerospace. I mean, they should be doing really well. These are really good economies right now, really good markets. So they announced their earnings. The stock rose. It's a $140 billion market cap company. These guys have $40 billion in revenue. They are growing 7.45 for the trailing 12 months. Looking at the quarter they just announced, they grew by 7%, and they are on a nice run of growth. This is a big outfit, so growing at these rates, it's very good. They are profitable. Gross margins are not great. Welcome to industrials. Welcome to aerospace. Their cash flow is expanding over time. That looks good. So 6.1 billion in free cash flow. The margin's 36.9. Not very high gross margins, but that's because, especially around government contracts, they have to do cost plus. So it really limits their profitability. So 6.1 at their growth rate. They're worth 90 to 120 billion minus debt. And how much debt do they have? They have about $24 billion in debt. So just call it a $100 billion market cap company. They're above that, which is why the market just is not buying into them because, where are we going to get the lift in value? Where are we going to get more cash flows? It's hard because they have a ceiling on their free cash flows. They'll probably have a ceiling on their profit because your starting point is 30% on gross margins. So Honeywell would be just kind of a sideways trading stock with maybe some decent appreciation from year to year, but that's not what I'm after. I'm not after decent. I'm after great. I want a big return, and I'm going to have to buy stocks. Some of them are going to work. Some of them are not going to work as well, but I'm aiming for very good returns, and Honeywell just wouldn't be one of those stocks that I'd be interested in. So they announced today, congratulations to anybody who's writing up the stock. Now, going in the opposite direction is Deckers. Deckers is a shoe company. They're probably best known for those is it Kuka or Hoka shoes. They're really comfortable. They're made for ultra marathon runners. People love them because they're really comfortable. They also have the Deckers, the UGG line of products. So UGG boots, UGG shoes, UGG apparel. And they were doing quite well. They were growing nicely, but the market just did not like their earnings. The stock is selling off by 12%. And this stock has not been working. It was working for a while. And then all of a sudden the market said, not so fast. Maybe the tariffs have really hurt them. But something really changed the direction of this stock. It really came off a cliff and it stayed down. Let's take a look at the valuation of these guys. I do have a full valuation on Deckers. They are growing 12.6 for the trailing 12 months. In the quarter, they just closed 9%. And their busiest quarter is going to be the quarter that we're going to operate in. They closed their books for September 30th. They'll close books for Q4 on March. That doesn't make sense. This is September. Okay. Yeah, it makes sense. So their Q3 will be the Christmas holiday quarter. And you see how that's a bigger number than the other quarters. So we're looking at for this quarter to really be a big one because that has all the holidays when people buy gifts, big shopping season. So these guys, decent growth. I mean, 9%. Nike would love to have 9% growth, but they don't have it. Gross margins are decent. I think they're high 50s, I think. Gross margin, 56%. So that looks pretty decent. Cash flow, not good. Not consistent and not good. So these guys have good profits, but cash flows, man, they got to improve that. Where's all the cash going? Why are they burning so much cash? Analyst on Deckers. Some analysts are quite high on the stock. Maybe they're living in 2023 when this stock was rising so fast. And some analysts are bearish on the stock, 87 being the price target that this analyst has. But collectively, they think it's discounted by 30%. So the growth, we are operating in this particular year, growing at 11.5. Growth is going to be 8, 4.5. That's pretty good growth for this industry. Again, Nike is like, they can't grow to save their lives. These guys are growing and they are expanding their profits. That looks really good. So, interesting. So this stock is maybe, let's take a look at the valuation I have for them. I did prepare it before the stream. I'm coming up with a 35% discount. So that's a pretty good discount, but I probably want to wait for the stock to begin to establish a rally. And I'd probably want to study the charts. And I'm not a big chart guy. I'm not an expert on it, but my colleague that I do the morning streams with, he's got expertise on the charts. This is one that I'm going to feed into his process and see what he says, because when it starts going higher, I think Deckers is going to do well. But right now, it's not a liked stock on Wall Street, going down 12%. But, let it settle down, and maybe after today's or tomorrow's trading, if it's discounted at 50% and I wait for a nice upward rally, maybe then it'll be a good time to buy Deckers. So that is Deckers. That is stock number 15. And we are moving to stock number 16. That stock is Union Pacific, the railroad. And this stock, I'll kind of lead off the valuation. It's fairly priced. Railroads typically are fairly priced. They've been around forever. And this stock sold off today. They announced their earnings before the market opened. This stock hasn't done all that great. Year to date, not good. 1 year, not good. 5 year, not good. All the way around. So railroads, they operate well. And old school investors like Warren Buffett really like railroads. I don't like the returns. And I think I would grant railroads the stability that they have is, I think, a point of desirability. But all other things, they don't look super exciting. Like, they don't get high PEs. They're, according to analysts, they're discounted. The growth doesn't really exist in the last couple of years. We had supply chain issues and companies had to pay expediting fees. They made some money, but on other years, not good. It's not consistent revenue growth. Looking at their gross margins, the railroad business has a good gross margin, 56%. Profit margins are good. It's just this thing's fairly priced, and I don't want to buy fairly priced. I want to buy something that's going to be worth a lot more in a year. Analysts are divided on what this thing's worth, but they all think that it's at least worth the stock price that it's trading at today with some upside. The economy, I don't think is doing great, but it's not doing terrible. And the reason I bring up the economy is if people are buying a lot of stuff, then the railroads are going to be more active and have more revenues. But I don't know that we have a booming economy. I think we have an okay economy right now. And we're seeing that they're not going to grow very much. I don't know what this is all about, 15% growth. Why would it be growing so fast in the outer year? I'm not sure about that year. But, they're going to grow nice and steady. I guess if an investor wanted a nice steady stock, maybe pick up that dividend of 2.5%. Yeah, I can't argue with that. You want something a little more secure, a sure bet. Union Pacific might be a good idea. It isn't overly expensive if you judge from the past year or even year to date. But I'm just worried that, it's just going to be capital that's going to be sitting at a low rate of return. If I'm looking for a yield, I could always get it in the form of bonds, and then I remove the risk of equities. So Union Pacific was down. It's not exciting. And my valuation shows that it's fairly priced. So that is Union Pacific. All right. So that was stock number 16. We covered a lot of ground. And don't know if you guys have any other questions, but maybe that's where we can land the plane. Tomorrow morning, we are going to stream. Daryl and I are going to stream in the morning, 9 a.m. Eastern, 6 a.m. Pacific. If you're up for it, join us. We can go over the stocks that are going to be announcing in the morning. And I think in the morning, we're going to have Procter & Gamble announcing their earnings before the market opens. Sanofi, Southern Copper, HCA Healthcare, General Dynamics. So we'll have a good string of stocks that are announcing before the market opens. Join us if you've got time. Coca-Cola? Oh, this is Coca-Cola, I think, down in Mexico. So it should be interesting. It won't be as, star-studded as previous to this week, like Tesla, but I think it'll be interesting. I've been buying into Procter & Gamble just to buy one more safe stock. I'm curious to see how they're gonna do in their earnings tomorrow. All right, everybody. So let's call it a night. Everybody enjoy the football game. Vikings, Chargers. Where are they playing? Are they playing in Los Angeles or in Minnesota? I'm not quite sure. So I'll find out soon. Thanks, everybody. Thanks for everybody who tuned in. Appreciate it. Hope you enjoyed the nice up market today, man. Really nice appreciation in portfolios. Hopefully you made some good money. And that's it. Everybody have a good night. Take care.